Hey everyone, this is Heather, and this is going to be our video on the Market Net Flow tool. So we introduced this about 2 weeks ago, and this has I think grown massively over the last 2 weeks, and I think there have been over like 50 or 100 requests for a new video. So this video is going to sort of tackle that. Uh, I'll start off with saying that I've been working on developing new tools for retail traders, and both for me as well, because I want to be a better trader for over 3 years at this point. And I think this is the second best tool or the first best tool that I've developed. The other one would be the Tradyflow tool here, which is extremely consistent and it has been working for over 2 years very consistently in both bullish and bearish markets. Having done some backtests on the Market Net Flow tool, I think this is either the first or the second best tool that we have at Tradytics, and it's been just amazing. I've been making my own plays. The entire community that we have has been making plays, and everyone has been really happy with this tool just because how simple it is and how efficient it is. So instead of singing praise, let's actually dive in and discuss what this is. So if you don't know what NetFlow is, I'll link another video in the description of this video, which will explain in detail what NetFlow and AlgoFlow is. Please watch those videos in order to get a deeper understanding of how AlgoFlow and NetFlow are created. I'll quickly go over what NetFlow is, but those videos are in a lot more detail. So NetFlow, this term, or net premiums is another term that we use for NetFlow, is just the total sort of accumulative value of puts and calls. So this red line is, let's say, not let's say, this red line is actually puts, but it's puts net premium. So net flow means the total amount of money that's spent on puts, both the inflow and the outflow. So that's where the net term comes in. So it's the total amount of money that's spent on buying puts and that's spent on selling puts, where buying puts is obviously a bearish sign and selling puts is obviously a bullish sign. If you sum those up, you get a line in a cumulative way. That's this red line that you see. So since this red line is going up, what could that mean? That could mean that because it's net premiums, which means, or it's net flow, which means what we do is we sum up all the bought positions minus all the sold positions, and that's the line we get for puts. If that line is going down, that means, and think about this for a minute, that means more puts are being bought right now, right? Because we are doing bought puts minus sold puts, which means the sentiment is bearish. So from the put side, we can see that the red line is going up, the net premiums are positive for puts, which means the market is bearish. Similarly, within this chart, you can see that the green line is going down. Again, it's net premiums for calls now, and that means the total amount spent on buying calls minus the total amount spent on selling calls. And if this line is going down, then that means more calls are being sold, which again is a bearish sign. So just to recap, buying puts is a bearish sign and selling calls is a bearish sign. Selling puts is a bullish sign and buying calls is a bullish sign. When there are more calls being bought, you'll see than sold, you'll see this green line go up. When there are more puts being bought than sold, then you'll see this red line going up. Now that we have a quick explanation of what the net flow means, why do we have this market net flow? So initially, I always like going over why we created a tool instead of just explaining it. So initially, we developed this net flow tool for individual stocks and then for SPY, QQQ, and IWM, which would show you the live options flow or the flow data in a very cumulative way in a simple chart for individual stocks. And then similarly, we did that for SPY and QQQ. You can see this here. And we started using the SPY's net flow, intraday premiums, net premiums actually, to make plays on the market. So let's say this red line going down, obviously this is a bullish sign because there are more puts being sold right now. We would expect, and let's say calls are being constant at this point in time, we would actually expect that the market should go up. And we realized that that was not very accurate. Like, we made a couple of plays for a few months, but all the time the results were very inconsistent, and we were not getting a really good performance out of the SPY or QQQ net flow tool. And I've written a few blog posts on it. If you watch the other videos, you'll see this limitation as well. We always discuss this limitation that because there is a lot of hedging going on in both SPY and QQQ, it might not give us really good signals. And understanding the market direction is the most important thing, because if you know what the market is going to, how the market is going to behave today, it's much easier to then make plays for individual stocks. So then one day what happened was I believe market fell down immensely. Like there was like a 4% move down in SPY. And that day the calls kept going up and the puts kept going down, which would mean that the market needs to go up. Because again, the green line is going up because more calls are being bought. The red line is going down because more puts are being sold. That was a very clear bullish signal for SPY. What happened was the price continued going down all day. Then when we looked at the flow of individual stocks, we realized that almost every stock had a bearish flow, which means the red lines in every stock were going up, the green lines were going down. Like it was really bearish in every stock across the market, but it was very bullish in the indexes. So that gave us an idea that maybe the best way to gauge the market flow is to combine all stocks and the indexes so that we can get a single picture. Because if we did that analysis that day where market dumped 4%, then we would have actually, and if we just summed up the net premiums for SPY, QQQ and all other stocks in the market, we would have very clearly seen that SPY was simply being used for hedging. They were buying puts continuously, and then they were hedging their puts by selling puts in SPY or by selling puts in SPY or by buying calls. So they were actually very bearish. The flow traders, they were really bearish, but that bearish sentiment was only being shown in the stocks, and it was shown massively in the stocks compared to what the flow was for SPY. So then we went back that day, and what we did was we just merged these net flow sort of graphs for all the stocks in the market to make this one chart. Now, even this day, you can see from here onwards, price keeps going down from 418 to 410, but people started to sell a lot of puts. And if you were just looking at this chart, you would think that maybe price is going to recover now. But if you go ahead and look at the entire market, I think that's the beauty of this chart, is that it enables you to look at the entire market within a single chart. If you look at this chart, then you can clearly see that the entire market is actually puts being bought, calls being sold, which is again a very bearish sign. And what happened? We continued going down. So we made like a $16 move down. And this net flow tool, the market net flow tool, caught the entire move. I don't think there are many tools out there that are this accurate in predicting the overall market as to what it might do. And this is the proof. Obviously, this is one day, this is one chart. I'd encourage everyone who's watching this video to go to the history, look at some other days of data, and then also go to our Discord bot. If you know about our Discord bot, good. If you don't, just sort of go to Google and write Tradytics Discord bots, and you'll sort of you'll go to their page. You'll get their page. But you can actually do a lot more analysis by just going back and looking at how this has worked in the past. I have run some backtests, and the performance is super accurate. In the last 1.5 year, that's the only data I had for flow. In the last 1.5 year, we had both a bullish market and a bearish market, and the total returns in SPY year to date, or maybe the last 1.5 year, have been like -5 or -6%. And this tool, if you make plays based on it, we'll discuss what strategies or what plays. This tool gave us about 20% in returns, which is obviously a huge difference. And I'm just talking about shares right now. So I hope you understand what this is and why did we develop this. Now, if you have this chart, then you can use it to gauge the market direction. And if you know what SPY and QQQ might do, then it's much easier to then go ahead and make your individual plays, Apple, Tesla, AMD, whatever you want. But this is the first thing that you need to be seeing before you actually make any plays, be it in SPY, QQQ, or in any individual names, because this is showing you every single thing that's happening in the options flow market, just this one chart. Now let's actually talk about what this chart is showing and then go over a couple of strategies, and then I'll end the video. I don't want it to be too long. So the red line is obviously the net premiums for puts. The green line is net premiums for calls. The white line is the price of the price of SPY. We compare this chart against SPY because we are really trying to gauge the market direction here. We're really trying to gauge the market direction here, despite the fact that this flow is from everything across the market. I think SPY seemed like a really good choice of comparing against the entire market's flow, and this has worked really well. Like, again, if you know where SPY might go, then it's much easier to make individual plays. So the white line is the SPY. Then this underlying bar chart, this red one, this one actually, this is our algo flow line. This is the bar chart. I didn't want to have 4 lines in here. This is just a summation of puts and calls. So since puts are higher than calls here, actually a difference. Since puts are higher than calls here, you can see this red bar chart. This keeps going down, and so this is the algo flow. If it's below 0, then we are bearish. If it's above 0, then we are bullish. If calls were higher than puts, if this green line was above red, then we would see these bar charts as green and above 0. And then this is the momentum indicator. If you're a technical indicator trader, then you'd know what momentum is. If you're not, then it's just the latest direction or the speed at which the net flow is being bearish or bullish. So you can see here, calls suddenly dumped and puts went up very fast. And at this point in time, you can see the momentum was, since the momentum was large, puts were going up fast, calls were going down fast again. You can see this momentum converted negative and we had these large bars. Then once the momentum or the speed of the flow stopped, as you can see here, puts are being very constant, calls are being very constant. You can see the speed stopped and you can see all this chop here. So you can use momentum to gauge how fast the net premiums are changing in the options market and then make plays based on that. I'll just discuss that in a minute. So I hope this is a good enough introduction to the market net flow tool. If it's not, please feel free to comment. I can make more videos, etc. So let's talk about the 4 strategies that you see here. So we are going to first talk about what the market cross. So the market cross is whenever the green and red lines cross each other, because when that happens, we are hypothesizing that a new move might start happening in the market, because the trend in the underlying flow in the entire market has changed. And you can see a very good example of that here. So we started the day, we were not really sure whether we wanted to go up or down. Then at this point in time, let's just skip the first 2 minutes, because again, too much volatility here. At about after about half an hour, you can see the puts started to go up, calls started to go down, and at this point in time, we actually had a cross. We actually had 2 crosses. Puts went down for a second, but then they went up again. So the puts line was below the calls line for a second, but then it crossed and it started going up. The calls line started going down, and that's what we call a cross. Let me actually show you more crosses, because I don't think this is the clear enough cross, so you might be confused. So, and when we are talking about cross, we are not looking at the white line at all. Okay, so this is a really good cross. This actually, because the green line went above the red line here, and then this point you can see the green line went below the red line, and look at how beautiful the move is. Ever since this happened, you can see we had, I believe, a $24 move down. And you might say maybe this is bearish market, so you're talking about all these bearish plays, but look at what happened when we had a bullish cross. When the calls went above puts, the market moved from 419 to 430. So again, an $11 move within like a day or two, let's say, actually just a day. So it's not just for bearish markets or bullish markets. This is a really consistent and a really comprehensive chart. And the proof is in front of you. Again, I'm not trying to exaggerate anything. So whenever these crosses happen, you can go in. So for example, when calls go above puts, the calls line, then it's a bullish cross, so we want to buy calls or buy shares. When the calls go below puts, when the calls line goes below the puts line, then obviously it's a bearish cross, so we want to either short or buy puts. So hopefully that's clear. Then we have the market momentum. So the market momentum is again when the speed of the flow suddenly switches to being very bullish. You can see we go above the zero line. The zero is the baseline here, and you can buy calls here. So, and as long as we stay above the zero line, we are assuming, or we are showing, the momentum is showing that the speed at which calls are going up compared to the puts here in this entire region is very fast and is significant. So during this entire region, let's say you bought calls here, you could have stayed in calls and then you could have exited here. So these crosses are slightly longer term plays, and longer term like an entire day or maybe a day or two. But these momentum plays, obviously, since they are based on momentum and speed, they are quick scalps for like 1 hour, maybe 15 minutes, maybe 2 hours, stuff like that, because you will see this momentum changing quite frequently. So if you are a very quick or quick term, short term trader, not quick term, sorry, if you are a very short term trader or a scalper, then sure, you can use the momentum. But if you are a slightly longer term, maybe a couple of days, or a day trader, then the crosses might benefit you a little bit more. Then we have the divergence play. So the divergence is obviously similar to how other divergences are there in technical indicators. It's when the price is making higher highs or lower lows, but this algo flow is making lower lows, or this algo flow is going in the opposite direction. So this is a really good example. So from this point in time to this point in time, you can see the price kept making higher highs. So this is going straight up the white line. But the algo flow, this bar chart, not these lines are sort of individual calls and puts, but the algo flow is a difference between these. So the algo flow actually went down from here. So this point in time was a divergence, and it was a bearish divergence. Bearish in the sense that the algo flow was not really agreeing with the price movements, and when that happens, we are expecting the price to come down. And so let's say if from this point onwards to this point onwards, let's say instead of both price going down and algo flow going down, let's say the algo flow actually went this direction, price went this direction, then we would look for a reversal play, because we are expecting the flow has turned bullish now, or is trying to turn bullish, and the price keeps going down. Then we'd like to make a reversal play, meaning a bullish play. Here we wanted to make a bearish play, and you can see obviously that worked pretty well. And then the last is the market trend, which is very similar to market cross, but it's a slight modification of market cross. So once you get a market cross, you should know the direction you want to play. So from this point to this point, you just want to be making bullish plays. But obviously we had this move up, but then we also had this move down. So how do you avoid this? One potential way to avoid this is to use a moving average, such as 20 or 50 moving average, to stay in the play as long as the trend is in your favor. So for instance, let's say we had this cross, and at, let's say, this point in time, we actually went above the 20 or 50 moving average. So this could be your play, this could be your entry. And I think about at this point in time, we went below both the 50 and 20 moving average. I'm talking about 1 minute charts here, since this is mostly just all short term day trading, scalping. These are not like month long plays. So you can use moving averages on one minute or even 5 minute charts to make your entries and exits. And that's a really simple strategy. But the problem happens in that strategy is when the market is in a choppy environment, then you'll go in and out because the moving average is staying relatively constant. So that's where I think some human element comes in. I ran some back tests using completely automated strategies, and I'm getting those 20% returns that I was talking about. compared to spies like -5, -6%. I'd highly advise always sort of adding some human element, some intelligence, add your mind into this market net flow tool, and I think you will do much better than the strategies that I was able to write in code or in an automated way. That's it for the video. If you want, if you stay in Discord, then what you can actually do is you can go to again our Discord server. We have our own server as well, or if you have a bot, then you can just use that to type in tr netflow space market, and that will give you this entire chart. Again, if you don't know what I'm talking about, just go to tradytics.com/discord, and you'll get tutorials on what I'm talking about. But I hope this quick tutorial will help you sort of get a really quick or very sort of preliminary understanding of what the net flow or the market net flow or the market net premium tool is, how to best use it. And I really hope this will help you make money in the market. This has helped me make money and stay out of bad positions and save money in the market. I'm really hoping this tool will open up some sort of good doors for you as well. If we are working on improving this tool constantly, since it was just introduced 2 weeks ago, so you might see some differences by the time you are watching this video, but the underlying explanation remains the same. You can actually, if you want to be notified of these market crosses, we have these web notifications. So just turn this on and you'll get a sound notification whenever these crosses happen or whenever the momentum changes. We don't have notifications for momentum right now, but again, I am going to spend a lot of time modifying some of this stuff, adding more notifications, creating more guides, stuff like that. So if this is slightly different by the time you're watching this video, just sort of hover around, ask questions, post in comments in this video, and we'll help you. But we'll hopefully have notifications for mobile, for Discord, and then obviously for web we already have these. And we also enable you to go back in time and look for some historical flow. We'll try to add more capabilities there, but as long as I think you understand the basic principle behind why did we create it and how does this work, you are good to go. You should use it, make plays, and hopefully earn some money. Thank you so much for watching this video. I'll see you guys around. Bye.